Good afternoon, everyone. Welcome to the NatWest Markets Brexit call. I'm Ross Walker, Chief UK Economist, joined today by my colleague Paul Robson, Head of FX Strategy. Just a quick note by way of introduction, because this call is open to the widest range of our client base, we're not able, for regulatory reasons, to talk about specific trade ideas, but we can, of course, talk about broad market themes and moves. And, of course, if you would like to follow up on any specifics on trade deals, do please get in touch afterwards. So by way of introduction, clearly no deal risks are rising. We put the probability of no deal at around 40%, which compares to our view of a 20% risk of no deal at the beginning of this year and something closer to 30% in the spring, just ahead of the opportunity to extend the transition period, which obviously wasn't taken. Clearly, 40% type probability means that we don't have a huge degree of confidence around the outcome here. The situation is clearly very fluid. But nonetheless, market participants, we think, will have to form a view, and part of this call will be about how we rationalize our expectations. I'll cover that part of it and then pass over to Paul Robson to talk about how we expect markets to respond. Ultimately, why do we expect a deal rather than no deal? Our view is guided really less by day-to-day ultra-high frequency developments and more about trying to take a step back and take a view about what fundamentally is in the interests of both sides. And that's what guides an expectation that a deal is still the most likely outcome, albeit a limited, bare bones free trade deal, largely confined to trade in goods, essentially removing tariffs, quotas, or preventing tariffs and quotas being imposed on UK EU trade. It's also, therefore, not a very ambitious deal. So from a ratification perspective, that should not throw up any major difficulties. You might recall when the EU and Canada cobbled together their trading agreement, the Belgian regional parliament was a block on that process. So we don't anticipate those sort of legislative problems this time, because we don't expect this to be, in the jargon, a mixed agreement. On the EU side, ultimately, there is a huge trade in goods surplus to try to protect, to preserve over 100 billion euros a year, and related to that, intricate supply chains for major European companies. So ultimately, we think the EU has something to play for here. And on the UK side, whilst most economists, ourselves included, think that Brexit will cause some damage, some disruption over time, a no-deal Brexit could still cause additional unnecessary damage in the early part of next year, at a time when unemployment is likely to be higher and rising. Still, COVID-related difficulties, a very fragile recovery. So in addition to those economic risks on the UK side, there is also a political dimension, which is perhaps not fully appreciated by international investors, namely that we think a disruptive, economically damaging Brexit would be more likely to fuel demands for a Scottish independence referendum, a second referendum on independence. We have Scottish Parliament elections next May, and a sizable victory for the SNP would reinforce their mandate for that referendum. So the political pressure is there, as well as economic factors, which we think ultimately will drive the UK towards seeking a deal and making some required compromises to achieve that. So ultimately, our view of a deal is grounded in this view that there is sufficient self-interest on both sides to avoid the worst disruption relating to no deal, essentially having to administer a system of tariffs, more onerous border checks, bureaucracy, paperwork, and the knock-on impact that would have for business confidence, investment, hiring, and so on. In terms of the timings, this will obviously be key for the market response, and we already have a bit more visibility, some key dates for the diary in the coming weeks and months. So the EU has said that it wants to see the UK's internal market bill revised and the threat to override parts of the withdrawal agreement around Northern Irish customs and state aid arrangements, for those clauses to be removed by the end of September. So that would be the most immediate pressure point. In the UK legislative cycle on this second reading vote expected tonight, we don't expect a government defeat at this stage, but over the next couple of weeks there will be a detailed and lengthy committee stage of the bill, the internal market bill, so opportunities for amendments there. And then, of course, the bill will go to the House of Lords, where the government does not have a majority, and where the Lords is not obviously constrained in terms of voting this down or seeking to amend this, because the government's election manifesto told us what a wonderful deal this was and how this would be implemented. So, in some ways, although tonight's vote in the Commons is getting a lot of attention, it's probably of most interest in terms of perhaps the number of Conservative abstentions or the signal that is conveyed in terms of Conservative unease about this measure. We think any actual amendments or the bill being voted down, that will come over the next week or two. So there is still time for this approach to be revised. The UK has put down its own markers. Boris Johnson suggested that if there wasn't some meaningful progress by the next EU Council summit in mid-October, the 15th to 16th of October, then the UK would pick up its bat and ball and walk away. We're sceptical about that. The hard legal deadline in this process is the 31st of December. So to get up and walk away in mid-October doesn't feel particularly credible as a threat, but it is obviously a risk. Previously, Michel Barnier had suggested that the EU wanted an agreed treaty trade deal text by the end of October. So again, October we could see increasing market volatility around these key dates. In reality, we think the process is going to run later, and if you work back from the 31st of December deadline, the end of the transition period, the European Parliament is scheduled to have a plenary session on the 14th to the 17th of December. That presumably would be the latest point at which the European Parliament could vote through, could ratify any trade deal, as it is required to do. And if that's the case, we mid-December for ratification, it's possible that a final agreed text might not surface until late November. So we sort of really view November as the key moment as to whether there will or won't be a viable deal here. But October, clearly you could see risks, tensions rising, fears of no deal escalating. So in terms of the overall strategy approach, as I say, our suggestion is that this issue clearly is not going to go away, and it is going to drive markets. We've seen in recent weeks that with Brexit having been off the radar screen, positioning around this issue becomes quite light. There's clearly various turns in the road ahead, and market moves, we think volatility will pick up from here. So fundamentally, it's about trying to take a view on what each side is trying to achieve and would regard as an acceptable outcome. And from a UK perspective, we see this latest threat to breach aspects of the withdrawal agreement primarily as a negotiating tactic, an attempt to put some pressure on the EU to lessen some of the stringency around some of the level playing field requirements, so around labour, environmental standards and so on. Admittedly, the state aid issue looks trickier, particularly the specifics around the Northern Irish Protocol, and related to that, this Article 10 issue whereby the Northern Ireland Protocol makes clear that any subsidies would not only be about those direct subsidies to Northern Irish businesses, but if there were linkages from mainland Great British businesses that might have implications. There's some tricky territory to navigate in the months ahead. But fundamentally, we can see some scope for the EU to lessen some of the stringency around level playing field requirements. Perhaps the eventual trade treaty would begin with some high-level principles, each side pledging not to engage in social, environmental dumping and so on. You would then have a dispute resolution process, possibly with independent arbitration as a way of concluding any impasse. But it seems that there is a workable compromise there. It's whether there is the political will to find that. But obviously in this process, the most important aspect of this for market participants will be how markets respond to these developments. And with that, I'll pass over to Paul Robson, our head of FX strategy. Paul.
Good afternoon, everyone. I think when it comes to the currency, I think we do have a playbook. I think some of the sort of inputs into that playbook will be different this time than they have been over the last couple of years. But we've been at these sort of pinch points a number of times. We can observe how sterling reacted in the past, and that will give us, I think, a good idea of what we should expect heading into the end of the year, but also into next year as well, because I think Brexit is clearly going to echo far into the future. I'm going to start just by pointing out some sort of high-level points and key statements, drawing on what Ross has said there, because it is very easy to get lost when you look at Brexit and the sort of implications for asset markets, because there are so many moving parts and developments are changing every day. So the first point I just make is I think it is clear that sterling, or the marginal driver of the currency, is Brexit. Obviously, there's some incredibly important economic themes currently going on in the UK, recovery from COVID-19, the level of economic scarring, the sheer extent of the decline in output that we've seen in the UK dwarfs anything that people were expecting in a sort of a short period of time from Brexit. But just watching how sterling is trading around headlines, Brexit is definitely back as the marginal driver. And then that's clearly just increasing risks of a no-deal Brexit. Some of the surveys that I've seen that sort of back up what Ross has just said there about the rising probability of a no-deal from 30% just in August up to 40% currently, and that's obviously in line with what Ross has said. But the baseline is still that a deal gets done sometime before the end of the year, and we give that a 60% probability. So ultimately, any weakness that we see in the currency short term will ultimately unwind. But it's really about the path to that deal, and we do expect the path to be extremely rocky. And because we expect the deal to be coming at the end of the year, we still have a couple of months. And as we get each day, as we get closer to the end of the year and that deadline, there is a risk that the market assigns a higher risk weighting to a no-deal Brexit, and sterling becomes more volatile, weaker until we actually get clarity on a deal. So sterling stays weak and volatile for at least a couple of months into the end of the year. And the final point I just want to stress is that while there is a likelihood that sterling does better on the signing of the deal as people become more confident in the future, the uncertainty is reduced, the fundamental support for sterling does appear weak going into 2021. Now, that hasn't always been the case after you have these pinch points in Brexit, but the economic scarring caused by COVID-19, the twin deficit position in the UK, the level of valuations for the currency all suggest that any improvement in sterling sentiment on the signing of the deal might actually be relatively short-lived. So just a few more details about how we're thinking about how Brexit feeds into the currency. And I guess the key question that people ask is, if you do expect a deal at some point, why is sterling weaker now? Why don't people go from A to C instead of going from A to B to C? And of course, the answer to that question is that the probability of a deal is a long way from 100%. 60% chance of a deal, 40% chance of a no deal, and the risks of what happens to the currency under those two outcomes is sharply different. And financial markets take all known information and they still it into one price. And here they've got two essentially mutually exclusive outcomes: deal, no deal. They have a probability. They have some idea about where the currency, or their expectation of where the currency might go. You add all that up together, and that gives you the prevailing market price. And at the moment, no deal risks are perceived to have been rising, and sterling has been falling. Now, obviously, over time, it will become apparent whether a no deal was actually negative for the UK, whether a deal is more positive. But certainly, when we survey the market and we ask people what they think, they're very much behind the idea that a no-deal Brexit is negative for the UK, and also a very limited free trade agreement is locking in a lot of the losses that have been sustained since 2016. So some of the things that might be mentioned is just the disruption to growth. The economy might become slightly less efficient. It might become a little bit more inflationary. And it might ultimately lead to a widening current account deficit. Like I say, it's still a lot of uncertainty about the exact impact on the UK economy, but that seems what the market is thinking about. So at some point, the probability of the various outcomes will go to one. So either we get a deal or we get a no deal. If we get a no deal outcome, judging by market surveys, we think that there's a chance of a 8% drop in the currency at some point. On a deal being signed, a modest recovery of around 3%. Certainly, that's consistent, as I say, with some of the surveys that we've seen. We don't think it's going to be evenly distributed between sterling euro and sterling dollar, because we think the euro will be impacted negatively from a no-deal Brexit, and then similarly will find some support from a deal. So just putting ballpark numbers around this, a no-deal Brexit potentially sends sterling dollar down to 120, and obviously we have a 40% probability of that. That's slightly higher than it might have been, say, last year, but of course the dollar is just weaker against a broad range of currency. So we concentrate in the percentage change in the currency rather than absolute level. And then just the final point I wanted to make before opening the call up for questions is this idea that even when we get a deal, the outlook for the UK economy remains challenging. And here it's Ross's view about he didn't go into a lot of detail today, but in his economic forecast, the idea that the UK has large twin deficits, so a large current account deficit and a very large government budget deficit. And you combine those two, and it's about attracting enough foreign capital to offset the large current account deficit, which would imply outflows from sterling every day. And this is a function of the growth performance or perceived growth performance in the future of the UK economy. And of course, the UK will have to be adjusting to Brexit in coming years, uncertainty for businesses and investment. We've got the economic scarring from COVID-19. This week's unemployment numbers will probably, unfortunately, highlight that. A large fiscal deficit means that there's not a lot of room for the government to stimulate growth to attract foreign capital. And largely exhausted monetary policy. So the Bank of England has done a lot, will do some more, but ultimately there's only so much the Bank of England can do to drive growth. So this idea of the twin deficits weighing on the currency, we think it's very shrill of others to talk about the UK's sort of emerging market currency because of the twin deficit. It's more important than that. It's about where growth is going to come to fund the current account deficit. So to bring everything together, we do expect sterling to suffer further bouts of weakness into the end of the year, potential to be very volatile. On the signing of a deal, some recovery, but into 2021, the currency, I think, will struggle against other regions where growth is potentially stronger and attracts more capital, potentially from the US, and it may mean that sterling dollar continues to drift higher, but that won't be, we think, because sterling is doing better.